Hi, I'm Greg Brown. I'm professor of finance at Kenan-Flagler Business School and also executive director at the Kenan Institute of Private Enterprise. So I want to spend some time talking about the economic impact of private equity investments. Obviously, this has been a hot topic recently. There's been political debate, legislation introduced, thinking about what are ways to mitigate bad things associated with private equity. But this really isn't consistent with the empirical literature. In general, the empirical literature suggests that, for the most part, on balance, there's generally positive things that happen to companies that are private equity backed. They tend to become more productive and more profitable, and there's mixed results on employment gains. It looks like there's really a lot of churn that happens versus net job losses. But there's a bigger issue at play. There's a potential reason why private equity investment could be really good for the companies that get the private equity investment and the investors that generate higher returns, but not necessarily be good for the economy as a whole. So, for example, what if these private equity companies just get really good at whatever it is that they do and take market share away from other companies in the same industry? So the economy as a whole isn't benefiting. It's just a mix shift towards the private equity companies that become better. So they're just eating the other companies' lunches. So the way that we could examine this is we can look at industries where there's been private equity investments and then look at all of the other companies in the industry and see what happens to them. Does their profitability go up? Does it go down? Do they increase or decrease employment? So we collected a sample of about 50 different countries, 19 different industries, more than $2 trillion in invested private equity capital over a long period, 1990 all the way up until 2017. We said when there's a private equity investment in a particular country, in a particular industry, what then happens to the publicly traded companies over the next few years in the same industry, in the same country? And what we find is pretty interesting. What we find is there's actually positive economic spillovers. So the companies that don't get the private equity investment, that is the publicly traded companies, their employment goes up, their profitability goes up, their productivity goes up. So maybe this seems a little bit counterintuitive at first, but we know that there are economic spillovers in other industries. We know that when there's competitive pressures that are applied, other companies in the same industry have to respond, and this can lead to broader productivity gains. It's an age-old discussion in the field of economics. This is what we document. So we find that, for example, when there's a private equity investment going into one country, over the next 2 to 3 years, there's as much as a 3% gain in productivity, a 1% gain in employment, and about a 5% gain in profitability. This varies, of course, by country and by industry and which sub-period we look at, but these are fairly significant numbers in terms of the magnitude of the gains. We also break our sample into different types of private equity investments. We look at traditional buyout investments, and we also look at venture capital investments. And here we sort of find, again, things that seem intuitive given the spillover story. We find that the venture capital investments tend to be more associated with productivity gains, and that's because venture capital tends to be involved with investing in more innovative technology that would result in productivity gains. And the traditional buyout investments are more associated with gains in profitability and employment throughout the industry. So these are very intuitive results from given the kind of competitive pressures that we might expect to be applied across the industry. There's also an interesting result from the broader economic development literature that suggests that only certain types of countries are going to be very susceptible to competitive pressures. And those are countries where the level of competitiveness is sort of moderate. And this is because very competitive countries, they're already really competitive. There's not much room for additional gain. Very weakly competitive countries, they probably have other problems. They have regulatory issues or governments that don't work very well, institutional constraints that are maybe more important than the competitive pressures. So it's these kind of middle range of competitive countries where the effects should be strongest. And again, that's what we find. It's that those middle countries where we see the strongest gains in profitability, productivity, and employment gains. So overall, I think the evidence from this study, which is a very large and comprehensive study, suggests that there's generally positive overall economic benefits that come from private equity investment.